Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome. I want to thank everybody for joining us this great Saturday. Thank you for listening. If you're catching it on the podcast, please send out the link to somebody you think may benefit from listening to the show. As you know, we're all about education. My name is Robert Kuhn, host of this radio show, president and founder of Kuhn Capital Partners. We're independent. We are a registered investment advisory firm, financial planning based, of course, but I don't think financial planning in the investment advice business is a differentiator. I think everybody should do it. Everybody needs to have a plan. I think the differentiator that we're bringing to the table is really twofold. Number one, the ability to make money when the markets are down. Maybe they will never go down again, but if and when they do, we want to make sure that we have strategies in place that can deliver positive returns when the markets are negative. Also, tax reduction strategies. Financial planning is something that we're focused on. When you look at financial planning, it is my belief that the most overlooked area of financial planning is tax strategies, tax reduction strategies. If you're currently working with a big bank or a nationally known brokerage firm, I promise you have very few tax reduction strategies that can reduce your taxable income, whether it's active income or passive income, greatly. Last year, if you were invested in the KCP Energy Fund, we were able to reduce your taxable income almost $90,000 per $100,000 invested. Now, we're not CPAs. Anytime you make a investment decision that has tax benefits, it's always best practices to speak out and reach out to rather your tax professionals. But in the energy space, these tax strategies are not even gray. They're very black and white. And also, we have targeted distributions on that strategy of 15 to 20% annual. So we do dinners. If you do have a net worth, not including your primary residence, of over $1 million, then you do qualify for the KCP Energy Fund. We do have dinners coming up in Naperville in June at Morton's. So if you'd like to learn more about that, see if you can attend that dinner. Make sure we have space. Please give us a call, 630-492-1912, 630-492-1912. Again, we work with all investors, regardless of investable assets, just for that particular strategy in the dinner. It is $1 million net worth, not including your primary residence. So give Paige a call, set some time up, get some time on my calendar, 630-492-1912. Certainly here in the Midwest, I don't know of a single strategy in the tax space that is giving you the components or characteristics of the KCP Energy Fund. Most people think energy is going back up over $100 a barrel. Realistically, nobody knows, obviously, where anything is going to go, especially a commodity like oil and gas. That being said, it really doesn't matter necessarily. We think the strategy works if oil is at $60 a barrel, and we know it certainly works if it's over $100 a barrel. So give Paige a call, 630-492-1912, because I think when you look at kind of, is a lot of what we want to talk about on the show. For those people that, I have the pleasure of speaking with throughout the week, it is people who call in from the radio show. My job, I think, in doing the radio show is at the heart of everything is education. I know what is on this station. I know the strategies that other radio shows are talking about. You probably understand those strategies as well. I don't know of a single radio show, certainly on this station and in the Midwest, that spends time talking about strategies that are not annuity based, that can still deliver positive returns when the markets are down. In addition to that, the tax advantage strategy, the energy fund strategy. Think about that. $90,000. It was just under $90,000. So I'm rounding up last year, but $90,000 per $100,000 invested, you were able to reduce your taxable income. So if you sold a business, you sold a building, you sold, other real estate property, if you make a bunch of money or you have a significant capital gain, here is a way to mitigate significantly that tax. And so 90,000 per 100,000. Now last year was high. Maybe 2024 will come in at 90 as well. But we want to be very base case driven, meaning we tell individuals to expect 70 to 80%, so $70,000 to $80,000 per $100,000 invested. I just think it's best practice to give something that I'm very, very confident that can be delivered. And then again, if it's 90%, you're certainly not going to complain. But think about that. In addition to that, you have targeted distributions that are not dependent upon the stock and bond market of 15 to 20% annual. Again, base case. Could it be a little more? Could it be a little less? Well, of course, this isn't guaranteed. But when we look at the risk and we look at the risk mitigation, nobody is bringing you a single fund in the energy space that is giving you the Permian Basin, world-class operators, and the diversification of oil and gas wells. So it just is what it is. We're very pleased that it is being very well received, and nobody on this station and nobody that I know of in the Midwest is bringing you anything close to this. So 630-492-1912. So the Dow this week, most individuals in the industry are going to quote the S&P. I think the S&P 500 is a better representation of what is going on, what the economy, what the market is doing, rather than the Dow. Most individuals, however, are going to talk about the Dow, but the Dow this week, Ray, hit 40,000 for the first time. So maybe, just maybe, the market will never go down again. I mean, I guess that is certainly a possibility, right? And I get so concerned that people are crafting plans that to meet and to achieve your expectation, your future cash flow needs, that you're going to have these significant rates of return. If you think about at least the individuals that I speak with and kind of the circles that I run in after 23 to 25 years, however long I've been in this industry, most people, and myself included, are not necessarily worried about a 2000 to 2002 where the markets were, down 3 years in a row, or even a 2008 where we saw a significant drawdown. We all know what happened in 2008, and many of you have, experienced that. And my concern is low growth for the foreseeable future. Low growth, high inflation. That is my concern. And I think it's the job of an advisor, even if we have that scenario, we have to make sure that we're still delivering positive returns, or at least have strategies that can deliver positive returns. And one of the nice things, if you've listened to the show, we do a lot of banknotes. I mean, these banknotes are so commonplace today. $1,000 minimum. Think about that. $1,000 minimum. It's just most advisors aren't doing them. 9 out of 10 advisors are not going to do them, only because they didn't grow up in their career of offering them. And when you're mid-career or later in your career, you've been in the business, 15, 20 years, you're not bringing something new to the client, because these banknotes are very labor intensive on our part, not your part, our part. But when I can provide a strategy, the last couple banknotes that we've done, 13%, 13.5%. The one we did last week was 12%. You get that coupon payment. Now that's an annualized payment, but you get that coupon payment monthly. So they take an annualized number, divide that by 12, right? So the last one we did was 12%. So that's 1% a month. You got that payment as long as the indexes that the note was following weren't down 30%. So think about that. 30% protection to make 1% a year or 1% a month. The note before that was 13.5. The note before that was 13. We've, Citigroup, Bank of America, JP Morgan, Morgan Stanley, UBS, Goldman Sachs, all of the banks offer them. They're just, again, if you're using fixed income, look at what's happened in the fixed income space over the last 4 years. You've lost money. I'm certain of it. Well, I guess I'm not certain of anything, especially in this market, but we're in the worst 4-year drawdown in the fixed income space. But yet your advisor is still using that as a portfolio stabilizer. Well, what if we had the banknote that was paying 13%, 12% annual, 13.5% annual, and we had 30% downside protection for you to get that monthly coupon? Again, that is something that a good advisor is going to bring to the table. What about the dual directional banknotes? I love it when people reach out to me and they say, hey, I want to learn more about the dual directional banknotes. Nobody on the radio is talking about that. Nobody. But I love it because my job is education. My job is to give you something actionable that you can better your investment situation than what it is currently today. The dual directional banknotes, very simple, 15-month investment. Again, backed by the largest banks in the world, JP Morgan, Citigroup, Morgan Stanley, Bank of America, UBS, Goldman Sachs, etc. Banks that you know of, all right, because we are buying their credit, right? It is a senior unsecured a bond, but it's just not a bond that you've heard of. It's not a bond that you're accustomed to hearing about, but it is backed by the credit of the bank. So we want to make sure that we're utilizing a bank that we know has staying power, right? And all of these banks that we're going to utilize do. But the dual directional banknotes, last one we did, it was a JP Morgan note, had 20%, almost 20% upside. So the indexes that it was following, you would receive in 15 months up to 20%. Let's just call it 20% upside. So you had, let's just say for hypothetical sake, it was tracking the S&P 500 and the cap on the upside was 20%. Well, they would look at the S&P today, and then they would look at the S&P 500 again in 15 months. And your return was 0 to 20%, whatever that cap was. So if the S&P did 5, you got 5. If it did 10, you got 10. Did 15, well, your return was 15. If it did 20, well, your return was 20. So you were capped out at, whatever the cap is. In our example, 20%. That's significant. Realistically, the caps have been 17. They've been 22. They're just kind of all over the board. But we know what it is going into the note. So short-term investment, 15 months. Cap on the upside, but here is what is so unique. It has an absolute return buffer. Again, I'm talking about things that nobody's talking about on the radio. We use the 20% downside protection. What that means is if, in our example, the S&P 500 is down from 0 to negative 20, your return after that 15-month period is the inverse return. So yes, positive. So for our example, hypothetically, the S&P is down 5. Well, your return's positive 5. If it's down 10, your return's positive 10. If it's down 15, your return is positive 15. If it's down 20, your return's positive 20. So big cap on the upside, the ability to still receive positive returns to negative 20%. And then if the S&P, for our hypothetical example, is down more than 20%, look at negative 20 as your 0. So if negative 20, so let's just, negative 20, you don't experience the first 20% of losses. So if the S&P is down, for our example, again, hypothetical, because we don't know what the note will be, but if it is down 21, well, you're only down 1. 22, you're down 2. Last year, $305 billion in protected strategies. We've got to talk about this. So a lot to get to this week. We're going to talk about inflation. exactly what that means. We're going to really spend a lot of time on that in the next segment. If you want to have a conversation with myself this week, please give Paige, my assistant, a call. She can set that up, 630-492-1912, 630-492-1912. More after the break.
When you think of a puzzle, what would you say is the most important piece? A corner? A side piece? I would argue the most important piece of a puzzle is the picture on the box, and the same can be said for your retirement. Robert Kuhn from Kuhn Capital Partners would love to show you your retirement picture. For more information, call 630-492-1912 or visit his website at kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. We're located in Naperville, 59 and 88. So centrally located here in the Chicagoland area. We do have somewhat of a national client base. We do have offices outside of Chicago, so we are running the show in multiple markets. So if you can hear my voice, then we can work with you. Again, I think if you look at the three differentiators of our firm, why you want to talk to us versus others or versus your current advisor, first and foremost, we are financial planning based. I think that is very, very critical. We incorporate strategies that can deliver positive returns even in negative markets. Again, that to me is what a pro does. Anybody can make money when the markets are up. A pro can make money also when the markets are down. These strategies are backed by the largest financial institutions and banks in the world. And then lastly, our tax strategies, again, significant tax reduction to the tune of last year, almost $90,000 per $100,000 invested, active passive income. Targeted distributions on the strategy are 15 to 20% annual. Those are the highlights. There's certainly considerations. There's certainly risks. There's certainly things that we have to talk about. But those are our three critical differentiations of why individuals want to talk to us. Number one, ability to make money when the markets are down. Number two, tax strategies. And number three, just really our growth plus our outperformance of the market in just our traditional growth strategy. So if either of those three components are appealing to you and you want to talk, have a second opinion, you have some ideas, you want to learn what we're doing, you want to talk about tax reduction, income maximization, you want to talk about these things, then let's have a conversation. 630-492-1912, 630-492-1912. Give Paige a call, come into the office, set up a Zoom, set up a conference call. Really doesn't matter to us. Let's just get that conversation scheduled so we can hopefully improve on your current situation. A little bit more on inflation. I know that the government seems to think that inflation is under control and it's not that big of a deal. And my concern, like I mentioned in the first segment, is low growth, high inflation. Low growth, high inflation. Low growth, high inflation. I guess the technical definition for that is not stagflation, because stagflation would be no growth. But low growth is still, I think, a real issue of, especially when we look at, where society is today, where, if you're 5 years out from retirement, 10 years out from retirement, or if you're in retirement today, low growth with high inflation could be a recipe for disaster, especially if you have just your traditional 60-40, portfolio. One of the things I wanted to mention on this show, and I hear it often when I talk with an individual that is just getting to know us. First off, it's just an educational call. We are on the radio as we are in our individual meetings. We're education based. My job is not to sell you. My job is not to tell you what you're doing is bad. My job is not to tell you that, we have the best strategies, that you have to work with us. My job is to explain to you that the traditional advisor is using a 60-40 balanced portfolio, and that's just not good enough. They don't do that with their own money. The firms that they're working for don't do that with their money. And they're doing it because it's easy to implement at scale. What that means is, for their income, it's phenomenal. They can bring on new clients. They can handle large books of business, $100 million, $500 million, $1 billion. And they know that it's easy for the investor to understand it. That's not good enough. That's not good enough in today's day and age, and especially with inflation doing what it's doing. We're having many conversations with individuals who have CDs that are sitting with money in money market rates, and they're seeing CD rates in the 4 to 5% range, maybe a little over 5, maybe even close to 6. They're getting money market rates of 5, 5.25, which again, relatively speaking, it's phenomenal compared to what we've been dealing with over the last couple of years. But you have to look at that return. After inflation and taxes, are you really getting ahead? CPI, which is what the government looks at as kind of their inflation indicator, they said is at 3.4%. Unfortunately, let's look at some of the things that we all deal with on a daily basis. And let's look at kind of what those inflation rates are. Car insurance inflation, 22.6%. Transportation inflation, 11.2%. Hospital services inflation, 7%. Car repair inflation, 7%. I mean, just look at, apparel, 13%. New cars, 21%. Food at home, 21.5%. Shelter, 22.4%. Food away from home, 25%. I mean, that is an issue. That is absolutely an issue. And if you're retired, or if you're 5 to 10 years from retirement, or, you've been in retirement for a period of time, you understand this. And that's a concern of mine. And as you know, we often talk about lifetime annuities, right? And I just don't think people fully grasp what you're buying. It's an issue. It's a significant issue, in my opinion. And then I hear people will say, well, you don't like annuities. That couldn't be further from the truth. We love a growth annuity at 5 years. 5-year short-term annuity. Right now we can get, really an annuity is just a structured bank note, kind of it's not that legally, it's an annuity, right? But the banknotes and the annuities, the hedging component of it is very, very similar. So we're not anti-annuity in any way, shape, or form. I'm anti-lifetime income annuities if you have over $250,000 of investable assets. The annuity that we use, 5 years, right? You get the first, today at least, the current rate is the first 11.5% of the S&P 500. That's it, on an annual basis. First 11.5% of the S&P. If you get a gain, that gain's locked in, never to go back down, never to go back down. So you don't need to worry about giving back your achieved gains. In addition to that, if the markets are down, you don't need to worry about using gains to make up for losses. It's as clean as simple as it gets. 11.5% currently of the S&P 500 on an annual basis. When you get that gain's locked in. If the markets are down, your return is zero. That's it. Your return is zero. So that strategy compared to the S&P 500, would you believe that over 15 years, if you started in 2007, you're almost exactly at where the S&P 500 is? But you had significantly less risk. You didn't have to worry about, do I sell out in 2008? Do I sell out in 2018? What we are against is lifetime income annuities if you have over $250,000. What you have to realize, if you have a lifetime income annuity, it sounds phenomenal. You get income that you can't outlive for the rest of your life. Well, who wouldn't want that, right? We all do. That's very reassuring. But here's what you're only doing. You are only taking your own money out of that investment until the account goes to zero. When the account goes to zero, then the insurance company is paying you out of their money. Guess what? They know actuarially, 99.999% of the annuities are not going to zero. Because if they were, if it was 50%, if it was 75%, they wouldn't be in business. So you're only taking your own money out until that account goes to zero. Here's how they hedge against that. Low growth. Low growth. I don't care what the illustrations say. Low growth. They're going to put a governor on the growth of the account. And then in addition to that, they're going to put a governor on how much you can withdraw a year. They know that account in almost every instance is not going to zero. So if you own that, if you are being sold that, let's have a conversation. You can't tell me that we're against annuities. I just gave you a 5-year growth annuity that we like. Gains locked in every year. Your worst year is 0. And currently you get the first 11.5% of the S&P. Pretty darn good fixed income or protected growth or safe money option. We're just against the amount of money that is going into the lifetime income annuities because individuals don't know what they're buying. They're told that they're getting a 7% growth rate. That's not on your real money. Think about that. What company is going to give you 7% today? It's not on your real money. So if you own one of those, if you're being sold one of those, if you are thinking about one of those, let's have a conversation. 630-492-1912, 630-492-1912. Let's talk about the bond market after the break.
Puzzled by your retirement options? It can be hard to put together a retirement strategy without being able to see the whole picture. Kuhn Capital Partners takes pride in providing comprehensive retirement strategy services to our clients. Our comprehensive services integrate all aspects of our client's financial picture in a coordinated effort to provide for financial clarity and multi-generational wealth. Visit kuhncp.com or give us a call at 630-492-1912 to schedule a consultation today.
Welcome back. You're listening to Destination Retirement. Individuals want to talk with us for 3 reasons. Number 1, growth outperformance. It's not going to change your lifestyle, but it sure is nice to outperform the market. Past performance is not indicative of future results, of course. Everything that we quote here is looking in the rear view mirror. It's not talking about what is going to happen, but we use history as a gauge. And our growth strategies rank in the top 5% generally of all like strategies. Our growth plus strategy, if you invested in that in 2015, you're up almost 700% today, where the S&P is just under 300. Again, past performance, not indicative of future results, but again, it's a good gauge. People like that. Number 2, people work with us for our ability to incorporate strategies that can make money when the market's down. You heard that correct. You can make money when the market's down if you have the right strategy in place. 3rd, people work with us because of our tax advantage strategies that can greatly reduce your taxable income. Last year, almost $90,000 per $100,000 invested in our energy strategy. Phenomenal. Targeted distributions, 15 to 20% a year, independent of the stock and bond market. That is why people are working with us. If either of those 3 strategies pique an interest, you want to talk about our financial planning process, let's have a conversation. We are independent. We are a fiduciary. Our custodian that we chose for our clients is Charles Schwab. Charles Schwab doesn't say we're good or bad. We just meet the criteria on a compliance basis to utilize them. So anybody who works with us, they open accounts at Charles Schwab, and we are the money managers on that account. So 630-492-1912, 630-492-1912. Let's talk about the bond market. Before I talk about that, I want to talk about 401ks. Most individuals, if you are over 59 and a half and you're still working, I know there's a lot of people where this radio show airs. We're headquartered in Naperville, just in suburban Chicago, 59 and 88, very centrally located. We also do run the show outside of the Chicago market. So if you're listening to the show, if you can hear my voice, then we can work with you. But there are many people that are still working that are over 59 and a half and still contributing, still working, and you still have a 401k. You have the opportunity in most instances to do what is called an in-service distribution. What that means is the tax code states at 59 and a half, you can take your current 401k. Now, every company is going to be different as far as if you can do it, but most allow it. Where we see some variability is how much you can take. Some people can take all of it. Some people can take 90%, 70%. That's what we have to find out. But what it allows you to do is take your current balance of your 401k and roll it into an IRA and not have to worry about taxes. You still contribute to the 401k as normal. It has no bearing on that. It's just allowing you to protect, to diversify outside of the 401k if you're over 59.5. We strongly encourage you to do that for many, many reasons. Now, again, we have to talk about it. We have to talk about the fees. We have to talk about the investments and all of that. Please understand that. But we can generally protect from the downside there's just many more strategies that you now have available. If you do an in-service withdrawal, if you roll that money to an IRA at Charles Schwab, we can help manage that money, and that is something that I would strongly encourage you to consider. If you don't know if you can do it, just give us a call, 630-492-1912. We have a list of companies that allow it, so we can easily tell you if you can allow it and then how much you can take. And then we always want to confirm it with your employer. Obviously, we just call wherever the 401k is, if it's at Fidelity or Schwab or Vanguard or whoever is administering the 401k, we can figure that out immediately. So 630-492-1912. U.S. bond market. The U.S. bond market is something that I'm very concerned about. I'm not necessarily concerned about the underlying investment. I'm concerned that advisors are utilizing that as the only risk mitigation tool inside of a client's portfolio. If your advisor has talked about balanced portfolio, if they've talked about, mitigating downside with bonds, listen up. There is a better way. And we are now in a 45-month drawdown in the bond market. Now, you say bonds is kind of like cars, right? They're all over the place. We're talking about the Bloomberg U.S. Aggregate Bond Index. 45 months. It's by far the longest bond bear market in history. Currently, this started August 20th. We're 45 months in. Maximum drawdown during that period, 17.2%. I probably don't need to tell you that in 2022, when the markets were negative, your bond money also lost significant amounts of money. I mean, this is an issue. It's an issue. And if there wasn't another option out there, we would just have to sit and take it. Unfortunately for you, your advisor probably didn't go above and beyond and make sure that you had strategies that still had safety, that still had the protection of principal component, or a large, some variation of protection on the downside, and you just lost a bunch of money. And that's just not good enough. It's just not good enough. So 45-month period, if your advisor has talked a lot about balanced and time in the market and not timing the market and all of that stuff, I mean, it's all true. I mean, of course, right? But ask them, how are you managing your money? How, Mr. or Mrs. Advisor, show me your bond portfolio allocation. Have them show you, right? And if there's a difference between how they are recommending you invest and how they are managing their personal assets and the immediate family members' assets, and there's a difference between those allocations, those strategies, and how they're managing your money, there's an issue. We need to talk about that. Again, 9 out of 10 advisors, they're just using, a buy and hold strategy. It is what it is, right? I would never pay for a buy and hold strategy. I would have to pay for active management. I would have to pay for active diversification. I would have to pay for outperformance. I'd have to pay to have strategies that can deliver positive returns in down markets. I would gladly pay to reduce my taxable income by almost 90% per $100,000 invested. Unfortunately, most advisors aren't doing that because they're already making a bunch of money, and it's easy, and they don't want to implement new things. That's not us. Our job is to find those advisors, educate their clients, bring those clients on to our firm. 630-492-1912, 630-492-1912. Thing advisors do a lot of is talk about averages. And averages are nice to hear. Averages, they just are what they are, right? The S&P, is up a little over 10.5% in 2024. The average return in the S&P 500 since 1950 is 9.3%. Another reminder, though, average isn't so average when it comes to investing. Think about that. Average isn't so average when it comes to investing. There have only been 4 times since 1950 that his stocks have finished between 8 and 10%. So think about that. The average return since 1950 is 9.3% on the S&P 500. There's only been 4 times since 1950 that stocks have finished the year between 8 and 10%. So odds favor a good deal higher or a good deal lower. And when we talk about averages, one of the things that I think is so critical, because so many advisors, that's all they talk about. They just talk about averages. Well, averages, again, since 1950, if you're 10 years from retirement or in retirement, what does 80 to 90 years worth of data really mean to you? I mean, does it mean anything? Because if you look at, again, if you bought Microsoft in 2000, so you bought Microsoft in 2000, it took you 14 years to get back to even. So you, again, great company. You bought Microsoft in 2000. It took you 14 years to get back to even. So does averages really mean anything? Especially if we're in a low growth, high inflation, environment. Should you, if you're over 50, or if you're 5 to 10 years from retirement or in retirement, should you be investing in something that has to have 50 to 75 to 100 years worth of average data to make you feel comfortable? I mean, my opinion is no, right? I mean, that my opinion, when you're 50 plus, 5 to 10 years from retirement or in retirement, you really have to have 4 components of a portfolio. We haven't talked about this in a while, but you need 4 components of a portfolio, because the markets they can go up, they can go down, and then go sideways. That's it. Up, down, and sideways, right? Most individuals listening today are going to make money in an up market. Most are going to lose money in a down market. And in a sideways market, most people have a buy and hold strategy, so you're not really getting much further ahead. So 2 out of 3 markets, you're going to have positive returns. And do you even know how to, really judge your advisor, whether they're doing bad or not? Have they told you how you're going to be able to look at them at the end of the year and say you did a good job, you added value, or you didn't do a good job? Most people look at that as just simply return based, and that's not the best way to do it. You either have a relative advisor or an absolute return advisor. The relative advisor, if they're judging their success or failure, it's simply based on an index. It might be the S&P. It might be the S&P and a bond index. Here's the problem with that strategy. That index could be negative. So let's go back to 2008. S&P was down 37%. Let's say your advisor only lost you 30%. Well, they did exactly what they were supposed to do. They beat the index. If you're judging and your benchmark is the S&P, they beat the index by 7%. They expect a pat on the back, but you still lost 30% of your money. I don't know. I wouldn't look at success or failure based on a relative benchmark, because, again, you can lose significant amounts of money. I would look at your return more of an absolute basis, meaning, did I lose money at all? If the market's down, well, what if I could hover around that flat line? What if I judged you, Mr. or Mrs. Advisor, on 0? Doesn't mean you're always going to make money. I mean, please, with all of your money, don't hear that. But that's how I think you need to look at an advisor. Because, again, if the markets can go up, they can go down, and they go sideways, right? That's it. So those are the only 3 ways the markets can go. Well, we believe to be able to beat a low growth, high inflation market, you need to have 4 strategies, 4 components, 4 sleeves, 4 buckets, call it whatever you want. And every bucket percentage is going to be different, is obviously customizable to the individual based on risk tolerance, based on portfolio stress testing, financial planning, etc. But you have to have protected growth. What is your protected growth bucket currently that you own? What do you know in your current portfolio that you know is protected against loss? Do you have any? What do you have in your current portfolio that you know that you could get 12%, 13% a year as long as the markets don't drop 30? Do you have any? What do you have in your current portfolio that you know that if the markets are down to a certain point, in our instance, negative 20, that you could still deliver positive returns? That's our protected growth bucket. That is the protected growth bucket. Some people will have 10% of that. Some people will have 90% of that. So what is your protected growth bucket? Do you have it? If you don't, we need to talk. Number 2, what is your growth bucket? Do you have over $100,000? Are you invested in mutual funds? Why? Why? Are you invested in index funds? Why? If you're working with an advisor and they're using index funds and mutual funds, why are you paying those fees? Because you're just going to do what the market does. When you look at growth and you look at our growth strategies, individual stocks, maximum transparency, 100% customizable. The tax benefits are the tax cost basis are yours. You own the individual stock. When you look at our growth strategy, our growth strategies generally rank that we use generally rank in the top 5% of all money managers, going back to 1995. So again, staying power, quantitative, active management, trying to buy $1 for something less than $1. It's really basic stuff. What is your Growth Plus bucket? Growth Plus, well, it's there to really try to outperform the market. You need some of that. It may be 5%, it may be 50%, but you need to have some of that. Our Growth Plus strategy that we utilize since 2015, again, past performance is not indicative of future results, but past performance up almost 700% versus the S&P at almost 300%. Significant outperformance. So we got protected growth, we got Growth Plus. Lastly, what about alternative and tax? Do you have any alternative strategies? All an alternative strategy is something that doesn't require the returns to be, they're not derived from the stock and bond market. They're going to act independent of that. What do you have in your portfolio that can do that? What do you have in your portfolio that can greatly reduce your active passive capital gains that you are experiencing? Do you have anything? So if you don't, again, markets can go up, down, and sideways. Most people who have a balanced portfolio, a buy and hold strategy, you're going to make money in an up market, lose it in a down market, stay even in a sideways market. That's just not good enough. In today's day and age, you have to upgrade your risk management strategies, your investment strategies. Are you still utilizing a cell phone that was popular in the 90s or early 2000s? Absolutely not. Why are you still using basic strategies then? The evolution of financial management, asset management, and really the availability of these strategies, this is unique now. This, like the banknotes we talk about, people think they're cutting edge. They are so not cutting edge. They are so, they've been around forever. It's just now you only need $1,000 to buy a note. Why isn't the advisor talk to you about it? I don't know. What about the tax strategies? What about getting in the energy space? If you own energy stocks, we need to talk about our energy strategy, because if you own an energy individual stock, no tax benefits, you get a distribution that's very low. When the markets, or a dividend that's generally very low, when the markets go down, whether energy is up, is good or bad, all stocks are good. Many stocks are going down when the markets go down. So if you like the energy space and you want tax benefits and you want 15 to 20% targeted distributions, you want to invest directly alongside the majors at the asset level, let's have that conversation. So 630-492-1912, 630-492-1912. Lots going on in the market. It's a tale of two markets, like I keep saying. We're going to talk about what a big brokerage firm said the next 500 points are going to be either up or down on the S&P. So more after the break, but if you want to have a conversation this week, give Paige a call, 630-492-1912, 630-492-1912.
Perhaps the most impactful piece of preparing for retirement is determining your current and future tax liability and developing strategies to minimize the amount of taxes you pay in retirement. Tax planning can have a large impact on your wealth and the kind of legacy you will be able to leave. At Kuhn Capital Partners, we provide you with a retirement strategy that can help you minimize taxes in retirement and take advantage of the 2024 tax rules. Visit KuhnCP.com or call our office at 630-492-1912 to get started today.
You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. And yes, we are a fiduciary. As you know, people are working with us for outperformance of the market. People are working with us to incorporate strategies that can have positive returns in negative markets. And people are working with us because of our tax reduction strategies that can greatly reduce your taxable income. Those are three core reasons why individuals work with us. Yes, it just doesn't matter how much money you have. I want to help the person with $15,000 just as much as I want to help the person with $50 million. Now, the strategies may differ, of course, but we're not going to be that firm that says you have to have $1 million, you have to have $5 million, you have to have $10 million. Our criteria to work with us: do you want to outperform the market with your growth strategies? Is that an interest of yours? Do you want to have protected growth strategies inside your portfolio, strategies that can do well when the markets don't do well? Do you want to have tax reduction strategies inside of your portfolio as well? If you're open to those three things and we want to work with you, we want to have that exploratory conversation. We want to learn more about what you're doing, and we want to share with you what we're doing. If it's a good fit, then we're going to have a great relationship long term. So 630-492-1912. Give Paige a call, and we can set that conversation up. So the markets, where are we going? Well, nobody knows. That's the reality of it. Is I don't know. You don't know. Your advisor doesn't know. The market doesn't care what I think. They don't care what you think. They don't care what your advisor thinks. The market is momentum based. That has been one of the single greatest changes that I have seen in the market, is that buy and hold strategies are getting left behind. If you're still using fixed income as a means of portfolio protection, we're now, as I mentioned throughout the show today, we're in a 45-month bear market in fixed income. The market is a momentum-based market, meaning the real money is made by following where the momentum is. So if you own, if advisors are still talking about buy and hold, we want to own growth. We want to own value. We want to own small cap, mid cap, large cap, because we don't know what asset class, blah, 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 blah is going to, it's nonsense. Okay. Nonsense. Our job is, as an advisor, and I hope that you respect this, I want to be friends. I want to know your family. I want to have a long-standing relationship. But at the heart of what we do, our job is to make you money, period. Our job is to make you money. And that is what an investment advisor does. So we look at where the next 500 points are going to go for the S&P. Are they going to be up and down? I have no idea. Nobody absolutely knows. Now, a lot of people think they're going to be down. A lot of people think that the next 500 points are going to be negative in the market. And that may be. And if that does happen, selfishly, that's okay with me, because it's when people lose money, they're open to new strategies, and they're open to new ideas. And with our clients, as I mentioned in the last segment, protected growth. If the markets go down, our protected growth and our alternative strategies are going to deliver. At least they have historically. Doesn't mean they're going to, I have to keep giving you that past performance is not indicative of future results, because it's just not. We're not rear view mirror investors here. What most advisors are going to do is they're going to show you something that looked good over the last 3 to 5 to 7 to 10 years. That means nothing about what is going to do well. We have to look at where we're going. And if we're in a low growth, high inflation market, well, we've got to have strategies like the banknotes. Again, what if we could get 13% annualized with monthly coupon payments? And you get that as long as the indexes that note is tracking are not down more than 30%. So a better way to look at it, you have 30% protection to make 13. Does it appeal to you? Well, it should appeal to you. So, again, the markets just are what the markets are. Couple very, very credentialed money managers have given the Fed. One quote was, "If I was a professor, I would give him an F. Treasury is still spending like we're in a depression. We have a 7% budget deficit at full employment. It's unheard of." Well, it is. But the reality is it can keep going. And that's what I get concerned about. I get concerned about a lot of individuals that will say, I'm sitting in money market, I'm sitting on the sidelines until there's a correction. Well, what makes you think that a correction's coming? What makes you think that a correction is coming? I mean, sure, my gut feel says that it's coming. But again, like I told you earlier, the markets don't care what my gut feel says. Markets may never go back down. I have no idea. But here's what I do know. I know that I have to craft a portfolio. I have to craft a portfolio that can do well whether the markets are up, down, and sideways. And I'm here to tell you that I believe 9 out of 10 advisors are not doing that for investors. And that is why we get the clients that we do, why people want to learn what we are doing, because the job of an advisor is to make money if the markets are down. I've heard the statistics. Statistics, a lot of times advisors use statistics to scare people. And one of the most recent ones that I've been hearing lately, I actually had a client say that. So I know an advisor must be talking to them, which is fine. Absolutely fine. I have no issues with that, because when you talk to multiple advisors, you see the value that Kuhn Capital Partners is bringing to the table. You see the value of protected growth plus, alternative tax reduction. Those are our 4 components. You see the value versus, a buy and hold strategy that has bonds and equities. So the statistic that I've been hearing a lot about, that I've been reading a lot about, the yield curve. It's wonky, really basic, but most people aren't going to take the time to learn about it. But the yield curve has only been inverted 3 times for 500 plus days or more. And we're in that period currently. 2008, 1929, and 1974. 3 times in history. All 3 of those times saw a market correction of 50% or more. That's probably going to scare you, right? But if you have multiple strategies, if you have the ability to make money when the markets are negative, or if you have the ability to deliver 12 to 13% coupon payments on an annual basis, paid monthly with 30% protection on before you don't get that coupon payment for the month, if you have the ability to greatly reduce your taxable income, you can see why I'm not concerned about things that I can't control. Because the markets are just going to do what the markets are going to do. If the markets run, guess what? Our growth and our growth plus strategy, they're going to just absolutely kick butt. If the markets go down, okay, great. Our protected growth and our alternative strategies are going to deliver. At least we believe them that they're going to deliver. My opinion is that we have to have much more diversification. You have to be able to make money when the markets are down. You have to be able to deliver, independent of the stock and bond market, tax reduction with mid to double digit distributions on an annual basis, targeted. So that being said, hopefully you got something out of the show. If you want to learn more about what we're doing, I always welcome the conversation. The initial conversations are so fun. Again, we're not here to tell you what you're doing is wrong. We're not here to tell you that we have all the right answers, that we're the best at this, the best at that, and we're the only ones with good ideas. I can tell you, though, it's been my experience that 9 out of 10 advisors are bringing you nothing close to what we're bringing to the table. So if you want to be able to, have less stress, still deliver regardless of the markets, I think it's worth a phone call. That being said, have a great week. If you want to schedule time on my calendar this week, reach out to Paige, 630-492-1912, 630-492-1912. More next week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.